Welcome back to the Deal Mastery Insider. Today we're going to look at another potential acquisition deal. Last week we looked at a business that was massively overvalued and had a bunch of headwinds and challenges. And today I wanted to look at a more interesting deal. And so I fired up this listing from Business Exits. It's an IT services business. It's growing remote with a potential CEO in place, right? So those sound great potentially. And high level, they're asking $8 million on just under $2 million of EBITDA or SDE, and off of $4 million of revenues, and that's about a 4x multiple. So the margins seem strong, though I'd want to make sure that's sustainable for an IT business. That's not crazy necessarily to have margins that strong, but I just want to make sure that I felt good about that kind of exit multiple, and that was. Or not the exit multiple, but the margins, and that was realistically sustainable on a go-forward basis, and that I wouldn't have to layer in a couple $100,000 of costs, because if I did, then ultimately that's going to raise that price pretty meaningfully, or that entry multiple. But $2 million of income on a 4x multiple is a very reasonable asking price for a business of this size, especially for a business that could potentially be operated remotely and that has a potential CEO in place. So overall, I really like some of the initial factors here. The super high operating margins is kind of a double-edged sword. I think to some extent it's a positive that the business operates at high margins. On the other side of the coin, I think it's a little bit of a negative that the margins are so high that I would be concerned about that. Now, there are some other concern points as well, and maybe some things driving the fact that this multiple is about a 4.1x. But you can see here they do sort of ERP implementations, Microsoft 365, public sector, municipalities, and governments. The big challenge you have on this deal, and probably part of the reason, because an IT firm doing about $2 million of income in a lot of cases will price well above this, 6x, maybe even higher, because MSPs, managed service providers, IT, very hot sector right now with a lot of potential. So we can see here a single client accounts for about 60% of their revenue, but with a big pipeline. So 60% of revenue on a single client is definitely a risk and a concern factor. And that's going to scare away some potential buyers. It's also going to scare away some potential lenders. And so that's something you'd have to be really comfortable with. If it's a municipality, which they mention up here, maybe there's some factors that are de-risking that, making you feel a little bit better about the risk profile. I'd want to understand, is it a contract? How could it be canceled? How long is it? Et cetera. And so all of those factors would go into my assessment of this, but my guess is the reason you're seeing $2 million income IT business that's remote with potential management in place and about 30 employees trade for a lower than market multiple is probably because of this client concentration. And so I think it's a really good illustration as well of how client concentration or customer concentration can impact the company's value. But that said, if we look back, the historical is founded in 2018, so it's about a 6-year-old business, and it looks like they have had a good August, and maybe a good TTM through August of this year, and they're on pace to have a pretty profitable 2025. They are on a trailing 12-month basis comping a bit ahead of historicals, and so another thing that I'd want to investigate further, if I really took a hard look at this deal, would be how sustainable is it that the business is going to keep doing this sort of $1.9 million, give or take, of EBITDA or earnings, net income, whatever you want to call it, versus more of the historical band in kind of the 1.3, 1.5 range. And so that would be another big diligence item, is understanding the historical earnings of the business and making sure I felt good about that. So customer concentration, historical earnings, I won't call it volatility, but just business has been growing, which is great, but also historically it doesn't have a track record of profitability at the 1.9 million or higher range. So that's something I would think about. Entry price is great. Love that it has management. Love that it has existing employees. It's remote. IT is a really scalable business. It's a hot sector. And I think one of the things I would consider as a potential thesis if I was going to buy this deal would be really thinking about buying it and then actively trying to deconcentrate it. And by that I mean find and or build a customer base over time that helps shrink this number down from 60% to ideally 10% or less, or maybe even 20% or less, that would help meaningfully from a future exit standpoint. And you could do that by buying other IT businesses into this business that slowly diversify that without actually shrinking that customer's revenue, or by growing it organically. So just some food for thought. And then I quickly underwrote this deal as well, just to give you a sense of how I would roughly estimate this. With the new SBA pari passu program, it could be an opportunity to do this deal pretty attractively. So setting aside questions of due diligence that you obviously want to make sure you really analyze and understand, here's a possible deal structure that I would consider. It is the 27th, not the 17th. Here's a possible deal that I would consider just from a financing standpoint. So we have $1.92 million of SDE. They're asking $8 million. I assume $250K of deal expenses. These could be loan fees, quality of earnings, legal, etc. So it gives us a total deal size of $8.25 million. Of that, I assumed potentially an SBA pari passu loan of 85%, which would be just under $7 million of proceeds. It mentions here in the listing that the seller is potentially open to some sort of carry or rolling equity, but they prefer a full exit. Every seller would prefer a full exit. That doesn't mean that's what they necessarily get. And so based on that, I think proposing something with some combination, this could be an earn-out, it could be seller financing, could be rolled equity, some sort of seller deferred consideration in the 10% range is very reasonable, and I'd say maybe even at or below market, which leaves us with a need for about $650K of equity, right? And you could think about raising that from friends and family, or you could think about putting it if you had the balance sheet capital to do it. But buying almost $2 million of earnings for $650K equity investment should generally be, just purely from a financial standpoint, setting aside the rest of the deal, a pretty solid return profile, right? And so I ran some rough math here. If we assumed the $6.8 million loan at a 10.5 rate and a 10-year AM, which would be roughly what you'd see for an SBA pari passu loan, that's going to get us to about $800K of free cash flow after debt service, which is a DSCR of 175 at the senior. Throw in a seller note. I just picked interest only at 8% for this full $800K balance. It's another $65,000 a year, which leaves us $765 remaining. If you distributed, 100% of that free cash flow and didn't reinvest anything in growth, you could potentially return all of the invested equity year one, though that probably wouldn't be prudent. You'd want to save some back and reinvest it. But even if you reinvested or distributed a third of this, you're going to still pencil to really strong returns on invested equity, right? So what's a third of this back of an app? It's going to be like, $200,000, something like that. So $250,000, and that's going to be like a 30+% return on equity, right? Yeah, so almost a 40% return on equity there. If we just distribute a third of the profits after free cash flow. Now, that's assuming the business is healthy and growing and so forth. But the nice thing about some of these service businesses is there's not a huge need for capital reinvestment. You don't need to go buy a big facility or build a new plant or buy some heavy equipment. In a lot of cases, it's really just staffing, and you can often target that as you scale the organization up. You sign a new contract, you add some new staff associated with that. So financially, I like this deal, and that's really just mostly a function of the fact that the purchase price is really strong. The risk factors would be the customer concentration, some of the historical revenues not being quite up to par, though the business is growing, so that could be a good explanation for that. I like the size of the team, 30 employees. I like the fact that there's a potential CEO. I'd obviously want to diligence that better. But high level, this deal looks really attractive and interesting. This is something actually that I think is a really potentially compelling transaction. So wanted to showcase just a deal that was more interesting, given last week we kind of did a deal that I felt like had a ton of both operational headwinds and challenges, but also just was massively overpriced. So this deal, I think every deal is going to have some hair. This is probably the customer concentration is probably the piece I'd have to get most comfortable with if I really took a deeper dive at this deal. But high level, I think this is a really interesting potential deal, and wanted to break it down and show you guys high level how I would think about doing it.